Okay, all right. Good morning, everyone. Good afternoon, everyone. This is Mitchell Lee, Head of Risk at Synctera here, and we're going to be talking about getting into a successful fintech bank partnership with a focus on the due diligence process. So if you're here for that today, you're in the right place. I'm going to start by just giving a quick synopsis of what we do at Synctera. So we launched in 2020. We're powering the future of fintech, and we're an end-to-end platform that allows a fintech builder to embed banking products, to issue cards, and more. And what we're doing is enabling partnerships between fintech builders and community banks, and making that as efficient and as transparent as possible. And ultimately, we want everyone to win. So fintech builders to create, launch, and scale great products, and community banks to access new revenue streams and markets. So what is this webinar going to cover? We're going to cover kind of the front end of that process. In other words, how should fintechs prep for a bank partnership and the due diligence process? And there's sort of a meta question here, which is, what do banks view as a successful fintech partnership? And by extension, what do regulators care about? And this is really this balance between making sure that partnerships don't put banks at risk or to allow fintechs to evade regulations, but also enabling innovation, both for the banks and to improve our financial system, which is something that regulators have talked about, have put out white papers and guidance around. And so we are acknowledging that fundamentally innovation is taking risk. So the goal for me today is to kind of take a risk and compliance lens to this topic and make some of this audience, which may have founders, business heads, bankers as well, know enough to be dangerous on this topic and to be prepared for partnership and diligence conversations. So who am I? Why am I sort of qualified to talk about this? So as I mentioned, I'm head of risk at Synctera. One of the areas I run is our due diligence process here. And so I'm trying to bring a lot of the lessons I'm learning from my conversations and my work with fintechs and bankers. And I've spent my entire career in financial services. So most recently came from the Federal Reserve. I led our San Francisco Fed's FinTech group, where I worked with policymakers and bank examiners on topics such as banking as a service, crypto, fintech lending, et cetera. And the other fun fact is I am also the son of immigrants and small business owners. So that's me on the bottom right, not looking super happy, but we had a family business, a Chinese restaurant, a small one in Florida. And so this is what really makes me passionate about this space, which is a lot of the fintech founders and entrepreneurs that I talk to are focused on tackling this sort of underserved segment, these groups of population that may not have the financial services that they need today. So enough about me. And by the way, this is going to be a one-person show. So there's no fireside chat, no panel conversations here. So I'll try to keep this as interesting and as spicy as possible. We will do the first sort of 30 minutes or so to talk about this diligence process, and then we'll move to kind of a Q&A at the end of the call. So one of the first questions that I often get from a fintech is, before we even get into partnerships, why can't I just get my own bank charter? Or why can't I acquire a small bank instead of partnering? Ideally, that gives the fintech the most flexibility and control. And to me, this is kind of a classic buy, build, or partner decision tree. And the answer to this question is that, in short, to buy or build a bank charter is really difficult. The other day, I was looking at the OCC, which is our national bank regulator. I was looking at their handbook, and that was a handbook for national bank chartering. And the front page of it is this stately image of the Lincoln Memorial. And so it's conveying this idea of stability, of experience, of wisdom. And that's kind of what they're looking for when you're asking for a bank charter. They want to see a business plan, and that can be hundreds of pages that lays out very clearly what you're trying to do and also how you're going to raise capital. and they're looking for an abundant amount of capital. And there's a lot of sort of regulatory rules and ratios out there that say, okay, dependent on the type of risk you're taking, this is the amount of minimum capital you have to have. And then the last thing is they're also looking for a really experienced team and board of directors. And that experience includes deep banking experience, it includes risk and compliance expertise. It includes all the stuff behind that, policies and procedures, governance and controls. So it's a pretty high hurdle. And then the other part of this is that it will go through this regulatory review and approval process. And very likely it's more than one regulator and typically will take more than a year. So it's not for the faint of heart. And I would say not generally suited for earlier stage fintechs who are interested in trying to get to the market quickly with their product. And in fact, it's also a pretty difficult path even for some of our embedded finance players. So if you're a company that already has capital, is generating revenue, and you want to just add in a financial product, a banking component, even acquiring a bank requires a ton of regulatory approval. And there's actually a lot of rules around combining bank and non-bank businesses in an entity, including having to set up a separate bank holding company. So a lot of rules and restrictions around that as well. That being said, there are fintechs that have gone out and successfully done that. And those are some of the pictures down here: SoFi, Vero, Lending Club, SoFi most recently getting some of their approvals. And so it gives you a sense of the size and scale of the fintechs that are really looking at this route. They get to a point where the economics kind of make sense for them to think about even investing in the legal and the cost and the review process that they have to undergo. If you're a bank geek, which I would consider myself, there's a lot of different charter types, bank charter types that are emerging. So it is an interesting area to follow. Big example, Kraken, which was a crypto exchange, announced, this was now a couple years ago, that they were getting a specialized charter from Wyoming, which allows them to do certain things, restricts them from doing other things. And so there's this kind of interesting philosophical conversation happening right now, which is, what is a bank? You know, should a bank get FDIC insurance, or should it be required to get it? Should only banks have access to the financial payment system? So a lot of this type of debate and conversation happening out there, a lot of literature on it. So encourage you to check that out. Happy to talk more about that in another session, maybe someday. But today we're going to talk more about this partnership route. So what is kind of a bank fintech partnership? I want to talk through each of the kind of players in this partnership. The first one is the bank. The bank is enabling the fintech to provide that underlying financial product. So if you're the fintech and you're going out and you're getting a new customer, sign up an account, their deposits are actually sitting with the bank. If you're offering a card out there, that card is issued by the bank. If there are payments occurring, generally those payments are occurring over the bank's rails. So it's the bank that kind of has this operational and product infrastructure, and they also have the risk infrastructure and the bank policies and controls that go along with it. They're the ones that are directly interacting with bank regulators. And so in lots of ways, the way I think about this is that the bank is accountable. They're accountable to the bank rules and regulations, and they are also then performing that oversight, that monitoring of the fintech. They're the point of escalation for the fintech as well. And if you think about what I was just talking about, that sort of burdensome process, that difficult process of even getting a charter, they've gone through that process. And so a lot of this is about protecting that privilege, protecting that charter, and the powers that it conveys. The fintech, on the other hand, is the one that owns the product. They own the customer relationship. They're doing the marketing and advertising. They're doing the customer acquisition. They're doing the customer engagement. When the customer says that they have an issue, they want to call up someone, it's generally the fintech that's that sort of first line of support. And so that means that the fintech is also doing some of the know your customer checks, the transaction monitoring, because they know their customer best. They understand that profile of the customer and what they're typically doing on a day-to-day basis with the fintech's platform. So in this relationship, they are owning and they are responsible for the risk. It sounds kind of scary, but to me, it's just like any other business that needs to follow laws and regulations. It's just that certainly the bar is higher because we're talking about other people's money. But this is just like, another analogy would be the healthcare space, where certainly there's going to be more regulation when it comes to some of these really important topics. So this is really powerful when this partnership works well. You have the bank that is powering the fintech. They've got the expertise in risk and compliance. They've got that infrastructure. And then you've got the fintech that, again, is really close to the customer and is doing the innovating. When things go bad, it's generally one of two things. Either the bank has kind of mismanaged that relationship. They're not doing the right level of oversight or monitoring. It could be that they're actually too inflexible as well. They may not have enough product flexibility for the fintech to kind of do and innovate on the things they want to do. It could also be that the fintech is not doing the things it's supposed to do. Perhaps they're not conducting appropriate know your customer checks as they're sort of onboarding customers. And that can cause kind of fraud or money laundering that is occurring, again, over the bank's rails. So in that situation, you have difficult conversations that occur. And those are the problems that emerge where fintechs might get debanked, or banks might even be told by their regulators that, look, you're not ready for this stuff, and so you need to slow down or stop doing these types of deals. So this kind of ties into, what are the things that banks are focused on when diligencing the fintech? And we'll start with the basics. This is the basic legal entity stuff. So do you have a legal entity set up? Do you have the incorporation docs? Do you have charters? Have you identified your beneficial owners? And this is pretty much anyone that owns around 10 to 25% of your company, as well as all the sort of ID of that person. Very similar to maybe something a venture capitalist might ask for if they're doing their legal diligence. Certainly the same kind of stuff that happens when you need to open up a business bank account. There are other things tied to this. As an example, do you have business insurance? That's typically going to be required before you actually launch your product. And then do you have other things that are associated with you, like lawsuits outstanding or have already occurred, any sort of regulatory issues, a little bit more applicable to companies that have kind of already been out in the market. One of the things that I do get a question around is around entities that are outside of the US and they're expanding into the US. So I know we're talking a little bit more about sort of the US space here. We encourage those companies to set up a legal entity in the US if you're doing that. It's just simpler, it's easier for the partnership, and it's not that difficult to set up a legal entity in the US. So that's kind of the table stakes. You got to have that stuff in order. The second piece of this is kind of the economics of the deal. Generally, the bank is going to earn revenue when there's card swipes, so that's interchange fees, when there's transactions, when there's a certain number of customers, when there's account openings that are occurring. So that's kind of the income side of things. Also, if you as a fintech are creating a savings or a checking account and you're bringing deposits to the bank is really going to care about that as well. And some of these banks are actually looking for more deposit growth, but they're also interested in how that deposit growth is going to impact their balance sheet, and a number of different ratios that out there, like loan to deposit ratios and leverage ratios, that regulators are also monitoring. So if you are an existing fintech, you've already got a customer base and you're bringing some of that to the bank, that's an important topic. And that kind of leads to projection. So that's one way to convey what you're bringing to the table in terms of the economics. That being said, if I added up all the early stage sort of projections that I've seen, early stage fintech projections, we'd all be billionaires. And I think my point there is to say that, look, if you don't have a product in market yet, you don't have any customers yet, certainly the bank is going to take your projections with a grain of salt. In some cases, they might even haircut some of the numbers to get at something that they may view as more realistic. But there are other ways to convey traction. So if you do have a wait list, a legitimate wait list that has a number of customers on it, if you already have a strategic customer signed on, these are things that you can tell the bank just to give them an idea of sort of projections of what you're seeing in terms of traction. Again, if you're more mature, you've got some stuff in place, projections are going to matter more. The second part of this is also financial condition. So essentially, do you as a fintech have enough money to run your fintech? Have you raised capital? How much have you raised in capital, and by whom? And if you haven't raised capital, yes, maybe you're in the process of doing that. How much are you seeking? How much are you thinking that you're going to be raising, and by when? Again, if you're a more mature fintech here, this is where financials comes into play. Income statements, balance sheets. The more established and larger you are, the more important it is. And of course, if it's audited, even better. But if you have some numbers that you've already put together, let's say you're in business for less than a year, even that can be helpful. The other piece of this I would add is that even if you're an embedded finance company, in other words, you've got a business, it doesn't have any financial products today, it's still useful for the bank to see financials of that company, because in many ways, you're kind of the entity that is supporting this new business line or this new set of products. The last part of this is that banks care about your management team. The background of those folks, whether there's board of directors, whether there's advisors that you have, and they're looking for not necessarily that you have deep financial services experience. Certainly, there's a lot of really successful fintechs that are coming maybe from a different sector or more product and product or engineering focused. And so that's okay. And I think it's really about telling the story of how does your team sort of complement each other in terms of their expertise, and that they're legitimate. They're going to, be able to really run this business. One question I do get sometimes is, okay, do I have to have a full-time risk and compliance expert? And that's not necessarily needed if you're just really early stage, because we know that the funding that you have, the capital you have, super important. You want to use that wisely. You're focused on getting that product to the market. But if you have a more complex product that has risk and compliance needs, it doesn't hurt to have part-time resources. As an example, there's a lot of consulting resources out there that provide that sort of part-time chief compliance officer. And that can be, again, helpful in telling that story to the bank. If you're past a certain stage, let's say you're like a Series A fintech, you've got your products out there already, there's going to be a higher expectation that you actually have some in-house expertise and resources that are going to be able to kind of manage the volume and the day-to-day needs. So I'll pause here. There's a kind of common sense aspect of this, which is that the large and more established you are, the more the diligence that the bank is going to do. And that boils down to, you're going to have an immediate and real impact to their risk profile, to their balance sheet. So they're going to ask more questions, and they're going to ask more things that you may already have, like things such as policies and procedures. For earlier stage companies, and this is something I generally, and this is me talking to maybe the bankers on the call, I do generally recommend, and it's not always followed, that if you're an early stage, the bank should sort of treat the partnership like almost like a small cap stock investment, right? And with small cap stocks, when you're investing in that space, you're not putting all your money and time into one or two stocks, unless you're either really great at picking stocks or you're just really lucky, right? You want to focus instead on a portfolio of those companies, knowing that some of them potentially are going to do really well and others may not, right? You're trying to get that sort of diversification benefit. So I do encourage banks not to overdo the due diligence when there isn't any sort of immediate risk in many ways. The fintech may have minimal to no customers at that point. So it's not like they're generating a risk yet for the bank. However, it does cost the bank time and money to set up these fintechs. And so therein lies some of the initial risk. You have overhead costs, you have variable costs to set up and to allocate to those fintechs. And so you do have to make sure that they're hitting some sort of minimum, that they're hitting some sort of hurdle that conveys that, look, this is a real entity. It's a real business model. They have capital that gives them that runway, and it's a real team. And once they've hit that, it's much easier to have that conversation about partnership. So here I want to touch on sort of what are the risks that are being introduced in these relationships? And again, what are things that banks are going to want to really hone in on and clue in on when you're kind of talking about what you're trying to do? The first one is your product. And I think about this along the lines of two different layers. The first layer is, what are you actually leveraging the bank for? So is it a savings or a checking account? Is it a debit card, a business debit card? Are you offering some sort of lending product like a cash advance? Are you relying on the bank to do ACHs, wires, maybe even international remittance? This is the underlying product that you need the bank to do. And so there is an underlying risk to each of these types of products. There's also different sort of operational components to it. So this is kind of that initial conversation of, if you want to offer some of these things, you got to make sure that the bank can even do it. And then to the bank, they view this as also products that present different kinds of risks. So as an example, if you're opening up savings accounts for your customers, that's very different than a checking account, just because there's not going to be as many transactions that are flowing in and out of a savings account as in a checking account. And that can present different sort of risk aspects, such as ACH returns and other types of payments risk. So the bank is looking at each of these products very differently in terms of what kind of risks that it presents. The second layer to this is kind of, what are the features, what are the complementary products that you're offering as a fintech? So what makes you kind of special in lots of ways? Are you incorporating some sort of automated savings aspect? Are you doing investments as well? Is there a crypto component? For instance, are you linking this to some sort of crypto yield product? That's going to be important for the bank to understand, even if they're not directly providing those services or products. Remittance is actually a pretty good example of this, international remittance. So if you need a bank to do this, and this would be part of that first category, what do you actually need the bank for? It's actually pretty complex, right? The bank will have to think about the money laundering risks. They may have to have a correspondent banking relationship. So there's some operational infrastructure that they have to have in place to enable that kind of product. But as a fintech, you might be actually saying, look, I don't actually need the bank for that. I'm offering international remittance to my customers, but let's say it's just a referral, a button that sends them off to an established remittance provider, like a Remitly or TransferWise, right? That's very different than saying, hey, I want you, the bank, to help me do that international transfer. To the bank, what they're concerned about here is less about them actually doing the work, but the associated sort of reputational or legal risks that are being created. So even though they're not the ones providing those products, they're associated with you as a fintech and all the other stuff that you're doing. So they want to have a good understanding of not just what they're doing on your behalf, but also the other things that you're offering in conjunction with that bank product. The second topic here is the customer. So who is your target customer? And this can get into different types of criteria and demographics. So think about, a lot of the fintechs we work with are very focused on underbanked or underserved customers. And so what is the dimensions of that customer? Is that a certain type of underserved minority group that you're trying to target? Is it a certain age range? Is it a certain type of small business or gig workers? A lot of categories here. And the more you can kind of explain what your target market is, it helps the bank understand the risk profile. And there's a couple different dimensions that the bank might be looking at this through, and I'll give you a couple examples. So one is that consumers generally, they're going to have more protections. There's a lot more compliance and rules around consumer type products. And so if you're targeting, say, a lower income group, a certain minority group that is a protected class, there's things that you have to think through, like disclosures, advertising, even things like fee structures. Regulators don't like to see hidden fees, that sort of thing, when you're advertising. So this becomes more important for the bank to understand. The other angle that they're looking at is also from the standpoint of money laundering and fraud. So if your customer is cash heavy, so think of like small restaurants, convenience stores, liquor stores, that sort of thing, or if it's composed of non-US citizens, non-US businesses, these are the types of customers that generally may create more inherent risk around money laundering and fraud. And that's the type of stuff that the bank is also going to care quite a bit about. The other thing that we talk about a lot with our FinTechs is this aspect of alternative KYC procedures or know your check procedures. In the US, the requirement is that when you open up that bank account, you need to collect name, date of birth, address, and ID. And in the US, generally speaking, social security number is one of the gold standards for banks. Now, we know that today in this sort of digital environment, there's a lot of synthetic ID fraud. Social security number is not actually a great identifier. It wasn't designed to do that, but it is kind of the traditional standard. And so if you're saying, hey, I want to offer my customers an ability to not provide social security number, it's good to explain why, right? So is it because your customer does not like to provide social security number? Is it because your customer may not even have a social security number set up? A great example of this is actually students from abroad. So there's a number of FinTechs out there that are focused on that space, and they may not have their social security number set up, but they still want access to banking products. And so in those cases, what the FinTech is saying is, look, okay, this is our target market. They're not going to be able to provide a social security number potentially. And so we're doing alternative types of ID, including things like a student visa or a passport. So those are alternative forms of identification that you want to be able to say, hey, this is what we're looking for from our target market. And that way it kind of ensures that the types of customers that you're onboarding are truly the types of customers that you're trying to, obtain. There are other forms of checks here, things like liveness checks, where you have the customer do a picture of themselves or even do a brief video of themselves holding up their ID. And so there's a lot of ways to kind of prevent some of the synthetic ID fraud and fraud up front. At Synctera, we actually offer a lot of these tools in our platform to do these kinds of identification checks. And it boils down for the FinTech, this kind of trade-off, right? The bank will never say, hey, collect less information on your customer, because generally it's just good hygiene to know who your customer is, and it prevents fraud. But on the other hand, it does kind of raise some of the friction points as you're onboarding your customer. And certainly there's going to be some drop off. And so that's something that the FinTech always has to consider is how much are we collecting to prevent fraud versus how much do we do to create more seamless onboarding. And the bank is going to want to have kind of a point of view on that. And it's kind of an agreement between the FinTech and bank on what that sort of minimum standard is. So I'm going to take a pause here to just make a really important point, which is that I've just talked about some higher risk customer profiles, the cash heavy businesses, the non-US citizens, right? Those were my parents, right? Like I showed that picture up front. They're immigrants, they're small business owners. They had a small cash heavy business. So it was hard for them to get a competitive small business loan, as an example. And that's kind of the environment we're kind of in here today, which is that the traditional bank thinking on these issues is to almost deprioritize these types of customers because it may be too expensive to monitor or to onboard. It's not worth their time. And so they run away from these types of customer segments. What we're seeing now in FinTech is actually FinTechs that are running toward them. And that's because there are better tools today to reach these customers. There's better ways to underwrite them. And there's better filters for figuring out who the good customers are, right? And there's a significant market to be had in this space. And that's kind of the story that I think the FinTech needs to be able to tell and explain. And it's also where the risk tools and the risk management becomes really important. Now, banks that are kind of up on this space can actually offer some of those tools and say, hey, these are the things that we want you to use to be able to do and filter and screen customers and their transactions. Or it could be done through vendors that maybe the FinTech already has contracted with. And in that case, again, the bank is going to be super interested in your relationship with those companies. And that kind of gets to this last point about your relationships with other companies and service providers. So they really care about, what reliance do you have on your service providers and how critical are they to your operations? If it's a KYC provider, if it's a fraud monitoring engine, right? Have you diligenced that service provider? Have you assessed them? How do you get comfortable that they're using them and that they're going to be effective for you? The bank is also going to care about how it impacts the information security environment, the business continuity aspects of it. So if they go down or there's a security breach, how are you interacting with them? How do you keep your business up and running? So we've got Synctera, we've got a lot of templates, a lot of guides to help FinTechs kind of think through that list of service providers and how to even conduct those initial assessments. But that is something that banks are going to be looking for. So those are like kind of the big items. Certainly, if you're more established, there's other things that banks are going to be asking for. For instance, do you have all the existing policies and procedures, documents around how you're doing your risk and compliance? What is your sort of info security environment? How are you doing sort of software development? All these sort of questions to get at, again, if you have an existing environment, how are you risk managing it? And so gold star, if you have this stuff, in lots of cases, you may not. And this is where providers like ourselves, this is where we work with FinTechs to provide a lot of those templates, including things like policies and procedures. Okay, so final thoughts. I did want to kind of recap because I talked about a lot of stuff in a short period of time. So a couple key points here. Due diligence is really about managing this balance between keeping the banks and consumers safe, but innovating toward new customers and products. And that is a form of risk taking. And so the banks that are involved in space, they want to protect their charter, but they know that they're also trying to innovate and they're trying to take some risk. As a fintech, you have this choice of buy, build, or partner. But as we talked about, buying and building a charter or bank is really hard. So as an emerging fintech, as an earlier stage fintech, the partnership route is going to be a lot more seamless. But in a partnership, it means that you as a fintech own and are responsible for risk, but that the bank is accountable and will have this sort of overseeing, monitoring, approval role in that relationship. The legal docs, the capital and financial condition, the management team, these are three components that are super important. And you've got to have that in place before you can even have that initial conversation, or at least get to a productive conversation about partnership. And then the other pieces of this is really knowing and being able to talk through what you're offering as a product, who your customer is, and the types of relationships that you have with any sort of existing service providers or vendors. And this, again, helps the bank understand your risk profile. And then the important component of that is also knowing how to kind of tell your story, right? If you've got these higher risk kind of customers, what are sort of the tools and the things that you're willing to do to kind of mitigate that risk? So I will pause here. That's sort of the end of my presentation. And I will check and see what sort of questions are coming in. Okay, so I've got one question here that gets at, I want to make a fintech that could be in a sensitive area like crypto or cannabis banking. Is this something I can do? What do banks think about this? This is a great question. So the great thing about this is that, as I mentioned earlier, banks, and actually let me turn off this presentation. So banks in this space are interested in these types of products. There are banks actually in our platform that are actually interested in getting more exposure to crypto or cannabis banking. If you think about it, the neobank space is pretty saturated. There's a lot of competition out there, but there are these areas that are kind of the frontiers of risk, right? Crypto and cannabis banking being two of those topics. And so there are certainly banks that actually specialize in these spaces. They've actually built some expertise and compliance infrastructure around it. So certainly if you're trying to build products in that space, it will require additional diligence. So they're going to want to understand, as an example, in the crypto space, which is one of my favorite areas, who are you using to do custody? Who are you using to exchange your product? Are you providing some sort of yield product? So they're going to ask a lot more questions around that. But again, we do have banks, for instance, in our platform that want to get that kind of exposure. So my message to you would be continue, go forth, do that, innovate, create new products, and we'll find a way to work with you. Second question is, how does Synctera help us with compliance? Some banking as a service companies require fintech startups to have their own compliance program. Ouch. So it is important that as a fintech, you do have some sort of compliance program set up. And when I think about that, you think about as you scale up, and let's say you're a Series A company, you've got a bunch of products and customers out there, you're gonna want in some ways an in-house group to help you deal with those things, rather than, for instance, outsource that completely. Now, with that being said, Synctera, what we do is we try to focus on some of the earlier stage companies that are not going to have all that expertise set up. So this is where we'll provide policies and procedures templates, and these are going to be pre-approved by the bank. We also offer certain services where we supplement the fintech in terms of their anti-money laundering, their know your customer checks, their fraud checks. So we supplement them with some operational resources to help them manage those things as they kind of get up to speed and are able to kind of hire their own in-house resources. So a lot of guidance out there. That's kind of our purpose, is that we know that this is not what fintechs are good at. They're good at their product, their customer. And so we're trying to do what we can to ease that process as much as possible as you scale up. Let's see here. I would like to create a fintech that serves non-US companies and individuals in the commerce space. What is the best approach? So a lot of this is finding the right type of bank partner. I mean, there are going to be bank partners that are more focused on kind of an international footprint and the ability to work with non-US companies. There's all sorts of implications around know your customer, know your business checks that are going to be different than, for instance, in some of those other countries than in the US. I think the thing that you're going to want to figure out is exactly how you're going to approach those non-US companies. What kind of products are you actually offering, and what's the funds flow look like in those situations? And being able to explain that really clearly to the bank will allow you to get a really quick answer as to, is this something that bank will even want to do, or is that something that is outside of their risk appetite or even outside of their operational capability? What criteria should fintechs use in defining the number of partner banks they should have? Yeah, this is kind of an emerging question, emerging space. There's a couple of reasons I could think of where you might want to have more than one partner bank. The first one is that you've hit some sort of capacity with that bank. Maybe that bank says, hey, you know what, you've brought on a significant number of deposits, and for whatever reason, we need to slow that down. And so you're not going to be able to open as many accounts as maybe you'd like, or grow as fast as you'd like. In that situation, you might want to consider, okay, do we need a second or third bank to kind of fit with the scale that we're doing? The second criteria is generally going to be product flexibility. So if you're out and you're saying, hey, now I want to do this complex lending product, or I want to do international remittance, and I need the bank to do that for me, your bank provider, your partner bank may not have that capability. Could be that they haven't set that up infrastructurally. Maybe they just don't have the risk controls and mitigants in place to operate those types of products. And so that's another area where you might say, okay, well, I might need another bank to do kind of these more complex products, and maybe some of the deposit products that I have with my existing bank, I continue to do. So there's a lot of reasons there to do that. I'll throw in the third one, which is a little bit of sort of hedging. If you're situated with one bank, and again, as I mentioned earlier, when relationships don't go well, that bank may have to debank you. That can be disruptive to your customer base, right? You got to go back out there and tell them, hey, we're going to move your account to a different bank. And so sometimes having more than one bank can kind of reduce some of that risk. But again, that is a conversation that you want to be thinking about as you're kind of scaling. I mean, if you're just starting out, my recommendation is not to worry too much about having a multiple bank partnership. how much diligence does Synctera do on the fintech on the bank's behalf, and what is provided to the bank? So we have a set of questions that we ask of all fintechs, and it actually captures some of the things I spoke about today. Basic legal entity questions, your business address, who you are, who are your beneficial owners, as well as questions about your product, your customer base, and any sort of infrastructure that you have set in place today as far as risk and compliance. So do you have an actual risk and compliance resource on your team? Do you have policies and procedures in place? And that initial questionnaire is really to get at, how legitimate is this fintech and how mature are they? And so we're doing that, and we're collecting it, and we're actually allowing banks to have access to that information. There's more procedures and processes that happen after that, and happy to chat, if you're one of our banks or prospective banks, happy to chat about that process as well. Should the fintech plan to have a fully operationalized compliance and risk policy and procedures, or would it be sufficient to have 1 to 2 year roadmap to operationalize that? That's a difficult question to give you a straight answer. I think it really depends on what you're doing. How complex is your product to begin with? There are going to be very baseline things that you should have in place before you launch. One of the things that we try to do at Synctera is to kind of phase it out. So to your point, maybe you don't need all the stuff up front, but if you're going to do, let's say, an alpha or beta launch and you've got a limited number of customers, there may be less things that you have to do because you have less of a risk footprint. But if you're trying to do a full launch and you have thousands of customers coming in, there's going to be more kind of expectation that you have those things in place. And I think the important point there is that it's not just about having policy and procedure. It's actually also about actually doing it, right? Implementing it. And the bank does have the rights and the capabilities to go in and conduct an audit or conduct a monitoring to make sure that you're actually doing the things that you're saying you're doing. Let's see, what else here? A growing area of scrutiny is information security or cybersecurity. What are 1 to 2 key information security benchmarks that banks want fintechs to meet or to consider in a partner discussion? So this is a really good question. We didn't touch on all the InfoSec aspects. One of the baseline things is they want to see an InfoSec policy. So what does your environment look like today? What are sort of the information security standards that you have in place? If there are certain benchmarks that you're using to set that up, what are those, right? So there are some best practices out there. There's a lot of public information on that. And we actually provide a policy as a baseline that fintechs can also review and see if they're doing those things. So that's one big thing. The second big thing I would say is also penetration testing and vulnerability scanning. So as you're kind of standing up and beginning to get your app together, your site together, and you're about to launch, there are certain requirements that banks typically want to see in terms of having an external resource that is poking around and checking on your apps and your vulnerabilities and giving you kind of a somewhat of a clean bill of health to say, okay, look, this is a fairly tight environment such that there's not going to be issues as we kind of do a live launch. The other piece I'll just touch on is the vendor relationship that I mentioned earlier. A lot of our fintechs, they're all going to have some sort of cloud provider. They're all going to have maybe other types of service providers that they're working with to run their app or to run their site. And so banks want to understand who those service providers are. And again, what sort of controls do you have in place, SLAs perhaps, to ensure that if something happens, like a data breach or a security breach of any kind, that you have the ability to alert the bank to let them know that that's happened and that you're kind of taking steps to mitigate that risk. I'll take one last question, and I know we've run out of time, but if you've got other sort of questions, feel free to reach out separately or check out our website. We have KYC in place for our investment product. When onboarding a client, can we carry over to you or do we need to run it again? This is also a more complex case-by-case situation. If you have a KYC provider, it kind of depends on who that KYC provider is. So what kind of diligence assessment have you done? Are they highly reputable? Does the bank know who they are? So that's going to be important. What's the policy that you have in place for how you're running your KYC? What is the information that you're collecting today? That's going to be important. And let's say you're transferring over the bank. So the bank has a couple different options. One is that they can rely on the KYC that you've done, and potentially what they might ask for is all the information that you've collected just to see and prove that you've done that KYC. The other one is they might rerun KYC behind the scenes. So if you've got that data, they might still run it to check to see if it's done properly. And then probably the most burdensome would be to go out there and see if your clients may have not provided sufficient information, and you're going out and you're requesting them to provide that information again so the bank can rerun it. Obviously, the stuff on the former is better than the latter from a customer experience standpoint. And that's the part where have a conversation with us. It kind of depends on your case-by-case situation. So with that said, I love the questions that have come in. I'm glad that we've got a really engaged audience here. I hope this was helpful. Check out our website. Feel free to, again, connect with me. A quick plug, actually next month, we're gonna have my close colleague and head of compliance at Sigteris, Sarah, and she'll be talking about some of the things that FinTechs need to do around compliance once you're going live. So another really important topic, and actually some of the questions have actually come through today. So with that said, thank you very much, and have a good rest of your day.